I think at this point we can all admit that we're tired of losing money by holding on to our favorite stock. So in this video, I'm going to show you a way to protect your portfolio in this bear market by using the synthetic short stock option strategy. So I'm going to take you through an actual example by using AMD, and then we're going to talk about the benefits and the risks that come along with this strategy. The synthetic short stock is a bearish option strategy where you sell a call option and buy a put option using the same strike price. So since you're selling a call option in the strategy, you're going to need to own 100 shares or more of a stock that you choose. And the stock that I own over 100 shares of is AMD. I ended up buying it over the last few months for an average price of around $95, and since then it's fallen about 20%. And honestly, by the end of the year, I wouldn't be surprised if the stock hit $60 because of the waning demand that we're seeing for chip makers. People are spending more money on necessities like food, transportation, and rent, so people have less money to spend on discretionaries and especially consumer electronics that are a little bit more expensive. So with less consumer electronic sales, this means that chip demand is going to be lower, so AMD and other chip makers are going to see less revenue, less earnings for this year, and instead of continuing to get punched in the face by the stock, I'm going to be using this synthetic short stock option strategy. So we're going to go to the option chain, and the first thing that we're going to do is set our expiration date. Now, whenever you sell a call option, usually your best expiration date is going to be 30 to 45 days out. And the reasoning for this is because of the theta curve, or how fast your option is losing money from theta based on how much longer you have until your expiration date. So at day 120, your option is hardly losing any value at all. At day 90, your option is losing a little bit more value, but the sweet spot is day 30 to 45 days. This is when theta really starts to kick in and eat away at the value for your option. So today is July 3rd, so we're either going to set our expiration date for August 5th or August 12th. I'm going to go with August 5th since it's the closest. And the next step is going to be to set our strike price. Now, whenever you sell a call option, usually you want to go with an out-of-the-money call option or one that's above the current market value for the stock. That way you can sell your shares for a higher price than the current market value. But with the synthetic short stock option strategy, you actually want to go with an at-the-money strike price or a strike price that's closest to the current market value. And right now, AMD is trading at $73.76, so our closest strike price is going to be the $74 strike. So we're going to select the $74 strike price, we're going to enter 1, we're going to sell this option in order to open it, and then we're going to add a leg to this option strategy. So we're going to actually buy to open this option. This is going to be one contract just like the call option that we sold. We're going to set our expiration date and our strike price for the same on August 5th and the $74 strike price, and then we're going to select a put option. So reviewing the strategy one more time, we're selling a call option with 30 to 45 days until expiration with an at-the-money strike price, or a strike price that's closest to the current market value, and then we're buying a put option with the same details. And since the put option right now is a little bit more expensive than the call option that I'm selling, I'm actually going to pay a net debit in order to open this option, and right now Fidelity is quoting me for 45 cents. So this means that we're going to pay $45 in order to open this option. I'm going to preview, place the order, and let's see how this plays out. If AMD ends up coming down after I open these options, then we're going to be making money from the options. And the amount of money that we're going to make is going to be based on the delta values for our options. The $74 call option has a 53 delta, and since we sold this option in order to open it, this is going to result in a negative 53 delta. So for every dollar that AMD stock goes down, we're going to be making $53 from selling this call option. And then the put option that we bought has around a negative 47 delta. And since we bought this, we're going to have a negative 47 delta. So for every dollar that AMD stock goes down, this put option is going to gain $47. The call option is going to lose $53. So in total, for every dollar that AMD stock goes down, we're going to make $100 from our options. But since we own 100 shares of the stock, we're going to be losing money on that end of the trade. So for every dollar that AMD stock goes down, since we own 100 shares, this means that we're going to be losing $100, but we're going to be gaining $100 from our options. So overall, we're going to net zero for every dollar that AMD stock goes down. So this is more of a protection for your portfolio rather than gaining money. This means if AMD ends up going down to $65 by my expiration date on August 5th, instead of losing $900 by owning the shares, I would have gained $900 from the option, offsetting that $900 loss to zero. So that's the benefit of using this strategy. It's a really good way to protect your portfolio in case the stock continues to go down. But the problem is the risk for the strategy is whenever the stock goes up after you open these options, you're going to be losing money from the upside. Our total delta value for our options was -1. So for every dollar that AMD stock goes up, we're going to be losing $100 from our options. But since we own 100 shares of the stock, we're going to be making $100 for every dollar it goes up. But the problem is if the stock is above your strike price on your expiration date, then you actually have to get rid of the shares that you put up as collateral to sell your call option. So this means if AMD is trading at $80 on my expiration date on August 5th, instead of selling the shares at the new $80 market price, I have to sell the shares at my $74 strike price that I chose. So this ends up creating an opportunity loss to where I could have sold the shares for $600 more, but I chose to sell them at the $74 strike price. And really the worst case scenario would be if you got assigned early on the call option that you sold to where you have to sell your 100 shares of the stock before the expiration date. If you get assigned early, you have to sell those 100 shares at the time that person that bought the call option from you exercises that option. And if you get assigned early, you're still going to be holding on to the put option that you bought. So you're going to continue losing money by holding on to that put option. But if the stock ends up coming back down, we can actually make money by holding on to that put option. Since we paid a net debit between our options of $45, our break even for the $74 put option would be our $74 strike price minus our net debit of 45 cents. So this means if AMD is below $73.55 on our expiration date, we would actually make money by continuing to hold this put after we got assigned early on the call option we sold. So if AMD is $70 after we got assigned on our call option, we'd make $355 in profit. But again, we lost our 100 shares since we got assigned early, and now since the stock is trading lower, we can buy those shares back at a cheaper price. On the flip side, if your stock continues to go up after you get assigned, then your put option that you bought is going to go to zero. And if you want to buy the shares back, you're going to have to buy it at a higher price than what you sold your shares at with the call option. So essentially, you're buying high, selling low. Not the greatest strategy. And that's pretty much all I have for the synthetic short option strategy. Hopefully you found this video useful. If you did, show some love, leave a like. Thanks for making it all the way to the end, and thank you to all my patrons for their support. And as always, remember to stay positive, stay green. I'll catch you in the next one. Bye, guys.